Good morning and welcome everyone to this morning's session for November 10th. My name is Faith Ritchie and I am the Small Business Programs Manager here at the Arizona Commerce Authority, filling in for your usual host, Robert Theobald, this week. Before we get started with our presentation, I do just want to run through some of the resources available to you through the ACA. First and foremost, however, I would like to give thanks to our community partners. Without them, we could not make this possible. We've had some wonderful presenters throughout our time with Business Bootcamp, and we are just so thankful for them and their involvement with this. Just as a reminder, the ACA Small Business Bootcamp and Resource Collective is designed to help prepare small businesses of less than 20 employees emerge from the COVID crisis stronger than ever. It is a statewide initiative supported by our community partners, as mentioned in the previous slide. And we are happy to announce that our boot camp will last throughout this year and into the early winter of 2021. So please be sure to register for all upcoming sessions with us as well. If you have missed a previous boot camp or you want to go back to review, all of that information is on our website, as well as the slide decks and the videos that you're seeing like this morning. So we please encourage you to visit our website at azcommerce.com/small/business bootcamp, as well as our resource collective. The resource collective, in addition to our video guided sessions, is a collective of resources for you if you are looking for those additional COVID resources that we do not cover in our live sessions. Here is just a glimpse of what that resource collective looks like. As you can see, it has different industries as well as information provided to you. Some updates for financials. If you are looking for additional loan relief or grants, we do recommend these three for you to visit. That information and their links are here on this screen. If you would like those sent to you directly, please just let us know in the chat box and we can get those posted there as well. For additional COVID mitigation information, we do recommend you that you check out the website, azcommerce.com/COVID-19. This will give you additional resources outside of those learning tools from the Resource Collective and Bootcamp. And it also allows small business owners and businesses to leverage our programs here at the ACA. So from small business to workforce to manufacturing, there are available programs for you and your business. Please just check our website for additional information on how to get involved in these programs. The Small Business Checklist is an interactive and intuitive online resource that will help guide business owners to starting, operating, and growing a business here in Arizona. Commonly requested license information for local, state, and federal levels are all included with this checklist program. So if you are starting a business, if you are looking to expand your business, we do recommend that you check out that Small Business Checklist to make sure that you have all the requirements necessary for starting your business. And again, that checklist can be found at azcommerce.com/small-biz. If you do not find COVID information that you're looking at any of the resources mentioned earlier, there are additional resources located at the ArizonaTogether.org website. So if you're looking for additional COVID information and resources, please check the ArizonaTogether.org. We have two exciting sessions this week. Today, we are mastering our company numbers. So I know that we have a lot of great turnout today. I know we're going to really get into it because our local partners from SBDC is here. And so I'll introduce him in just a moment. But then again, on Thursday, law offices of Snell and Wilmer are returning to tell us how to motivate and incentivize employees, which is just so important. So if you haven't registered for Thursday's session, please do so. And that leads us into today's session. Today, Mike Bull, a business consultant and representative from Maricopa SBDC, is here to talk to us about mastering our company numbers. And so we are just so excited for him to be with us. We know that it's great information that all of us are looking forward to getting. So Mike, without any further ado, I am going to turn it over to you.
Thanks, Faith. And soon we will share. I hope everyone can see the introduction there. Once again, Faith, thank you. It's nice to be here. I want to ask everybody if they're comfortable and sitting back. Usually we are in a nice training room. We would be supplying coffee and donuts. Today, I hope you found a way to find your own, but thanks for coming and welcome to what I call Numbers Everywhere. And of course, your introduction was mastering your company's numbers. And yes, you just saw that picture of me. I've been a business owner for over 20 years. So either you can tell whether I know what I'm talking about after I talk, because experience and education don't mean anything if I don't sound like I know what I'm talking about. So anyway, I want to tell you a little bit about the SBDC. We are a resource partner of the SBA and funded jointly by the SBA, Maricopa Community Colleges, and the Arizona Commerce Authority. We have three main areas where we like to help small business owners. One is in training, where we do things like what we're doing today. We have lots of other training opportunities. We have a calendar on our website to show them. Our number one thing that we do is one-on-one counseling. This is at no cost to a business owner who wants to come in and talk to an experienced business advisor about starting a business, growing a business, sustaining a business, exiting a business, whatever. We have experts in lots of different fields, including funding assistance, writing a business plan, financial reviews, market research, marketing and sales, business operations, growth strategies. We have people who can help with export and international trade, with technology commercialization, and like I mentioned before, exit strategies. We also specialize in research, whether it's market research, industry research, whatever you can think of question, we can help you find an answer to it. And to request counseling, it's a quick, easy thing to do. Go to our website, maricopa-sbdc.com, click on the link that says request counseling. You'll fill out a request for counseling form. Once that's submitted, the rest is up to us. We'll be in contact with you. And enough about that. Let's get on to the day's show. So what are we going to be covering today? We're going to talk about your basic accounting reports and how to read them, what they contain, what to do with them. We're going to talk about basic accounting terms. Some of this people have already been through and know. I find that a lot of people who should know things don't. So we're just going to get a good baseline of what people know and don't know. And then we're going to talk about how you use your numbers to make decisions. Okay, sometimes I think finance and talking about numbers is fun. Some people think it's boring. So every once in a while, I'm going to throw in a cartoon just to liven up those that think it's boring. So yes, I am quite certain that there was absolutely no cooking of the books. Reheating, however, yeah, well, maybe. All right, first things first on this. Separate business and personal finances. This is so important. I see people all the time who, mix the two and think nothing of it. But what I am suggesting is, number one, maintain a bank account specifically for your business. Don't be tempted to use business and debit credit cards for personal expenses. What this does is it helps keep all business income and expenses separate, which simplifies record keeping and tax filings. People ask me all the time, should I get accounting software? Should I use it? My answer almost always is yes. makes things straight, makes things good. As you grow, you're going to need to anyway. If audited by the IRS, the burden of proof is on the owner to disclose income and expenses and to explain them and be able to tell them what they're for. The IRS is not the one that's going to help you sort this out. And the most important thing is mixing of business funds with personal funds can do what they call piercing the corporate shield. I'm sure most of you have heard when you start a business, people will suggest that you establish an LLC or a corporation so that you can protect your personal assets. This is all very good and very true, but if you start mixing personal and business funds, you've kind of defeated the purpose of that. And if somehow you have somebody who has decided they have a good suit against your company, a good lawyer will come in and say, look at this, they're mixing personal funds with business funds. They have nothing to keep them separate and show they actually have a business. Therefore, we don't believe, even though they have established the legality of one, they are not acting like a business. And that will pierce your corporate shield and you may become personally liable at that point. All right, those of you here today, my bet is you're falling into one of two categories. Either you love numbers and you're fascinated by them and you want to learn more about them and you want to use them, or you're just totally frightened by them. If you're in the first category, you're probably delighted to see this webinar being offered and signed right up. If you're one of those in the second category, you're probably intimidated by the very prospect of sitting here and wondering, what the heck am I doing here? Well, don't worry, I'll try to be gentle and make this easy for everybody. So we're going to talk about the keys to business success. Number one, if you shy away from dealing with numbers, it's really easy to get into financial trouble. If you don't learn to pay attention to your ongoing financial situation, you need to, because it will help you avoid any unpleasant surprises. Even if you leave the number crunching, bill paying, and financial data entry to somebody else, please familiarize yourself with how to read and understand your financial statements. I call this outsource the work, not the knowledge. Too many times I see and talk to business owners who say, oh, yeah, I don't know what all those numbers are. My accountant handles that, or I just send those to my bookkeeper. I don't know. Well, if you're outsourcing the work, that's fine. But if you're outsourcing the knowledge, then you're not being a good business owner. Numbers help you make better decisions and you get to retain more control over your operations. You're running it, it's not running you. Numbers represent your decisions. So take heart, numbers are not magical, mysterious, or menacing. They merely reflect the decisions you have made previously in your business planning. If you decided to advertise each week in your local newspaper, yeah, well, there's a number attached to that. If you projected sales at a certain level, there's a number attached to that decision as well. Numbers aren't just details, they're vital signs of any business. You must understand your company's numbers to realistically assess the condition of your business. You may have heard this before, numbers are the language of business. I request you learn to speak it fluently. Reading your financial statements. Get in the habit of looking at them, of reading them, of knowing what they contain, at least monthly, and more often if you're not familiar with them, because it'll help you get familiar with them. Make your financial statements a good summary, not an overburdensome list of details. If you're more than one page of a profit and loss statement, you probably have too much detail in there and you probably aren't looking at it. I've seen people that are proud of their P&L because it's 4 pages long and contains every bit of detail they have. And then you talk to them about how much they use it and it's like, well, it's too long. I can't read this or make any sense out of it. There's a good balance between too little detail and too much. You need to track your items such as sales receipt on a daily or weekly basis. Know what you're doing in your sales. Know how that's working. Know where you're at. And don't wait for reports to come back from the accountants before knowing your financial position. If your accountant is 2 or 3 months behind on sending you reports, that may be way too late for you to make any meaningful adjustments to what needs to happen. And one that I really think is important is determine a few key numbers you like to keep track of. You don't have to memorize the full report. On a profit and loss statement, if you're concerned about your top line sales or one of the revenue streams, keep track of that and watch it and look at it. If you're worried about some other expenses, watch those, keep track of them. If you're worried about your balance sheet about things, pick some numbers. It doesn't have to be all of them. I think that's where people get most scared of financial statements, is they contain too much information and you just don't retain it all. You need to start with small, look at what's important, and then move on. The other thing is you need to set policies and stick with them. Whatever they may be, if it's a policy about collecting accounts receivable, if it's a policy about what customers can order and how they order. Follow those policies in good times and in bad. If you have an accounts receivable policy, if you need to collect in 30 days, and if someone hasn't paid you in 60, they go COD, then even in good times, keep that policy, because in bad times, it's really hard to go back to it. And many businesses, even big companies, get in trouble when they don't stay on top of things like that. Break. When I asked for documentation to support your expense claim, I was hoping for something more than a sticky note saying, "Trust me." Okay, our first definition, cash versus accrual accounting. A lot of people have heard of this. A lot of people don't understand it, and some do. But basically, here's what happens. There are two methods of accounting for income and expenses, cash and accrual. The difference lies in the timing when sales and purchases are recorded in your accounts. Cash accounting recognizes revenue and expenses only when money changes hands. Accrual accounting recognizes revenue when it's earned and expenses when they're incurred. For instance, if I am an office supply company and I sell a desk to an office supply store, I'm probably going to give them 30 days terms to pay the bill. In cash accounting, I do not count that as a sale until I actually collect the money for that. So if I sold it to them on November the 10th and I don't expect payment until December the 10th, then I don't count that as revenue until December. However, on accrual accounting, I'm going to count that as revenue today, because that's when the goods exchanged hands. That's when I did an invoice. And so I want to, in accrual, I want to account for that in November. Now, maybe I bought that desk from a manufacturer and he gave me 60 days to pay his bill. Well, if I got that desk yesterday, then in accrual accounting, I'm going to count that expense as happening yesterday. But I have not made that payment until now. He gave me 60 days. So I'm not even going to make that payment until next year in January. And that's when I would account for the expense under cash accounting. Does that make sense? Since I can't see your heads nodding, I'm going to say yes. And so the problem comes in what should I use, cash or accrual? My answer is, how about both? Because I think both of them have their place. And most accounting software packages will easily toggle from one to the other and back again. It's not something that you have to make a big deal out of. Most accountants are going to tell their clients they like to see a cash accounting. And that's mostly because it's more advantageous come tax time. However, I suggest to manage your business, it's better to use accrual accounting because you can match income versus expenses when they happen in the same category or in the same time frame a lot easier, and it's easier to manage that. So you can use both, and they both serve a purpose for different things. And if you rob from the rich and give to the poor, do you have to get receipts? Okay, our first financial statement is called the profit and loss statement. It's also called the income statement or a P&L statement. All of those are interchangeable, same thing, meaning the same thing. A P&L covers a designated period of time, whether it's a week, a month, a quarter, a year. Your profit and loss statement covers that. It demonstrates the ability to generate profits. That's what it does. It shows categories of a few different things. It's going to show revenue and income. And we're going to talk a little about this, about income. I believe should be 2 to 5 revenue streams based on what's coming into your business and how it's coming in. Again, if you have 20 revenue streams, my guess is you're not going to be looking at that very much because it's just too much detail. Your next section is cost of goods sold. Cost of goods sold is generally what it takes to purchase the items you're selling, to create the items you're selling, to create the service you're offering. Those are the costs that directly go along with the things you sell. And I preferably like to match those up to revenue streams. So if you're a bicycle shop and you say, my revenue streams are, I have new bicycles I sell, I have used bicycles I sell, I have parts that I sell, and I have a service that I offer to repair bicycles. So I might have 4 revenue streams. Well, I want to match up 4 cost of goods sold streams with that. So I'm going to say cost of goods sold for new bicycles, cost of goods sold for used, cost of goods sold for parts, cost of goods sold for service. That way I can match up my revenues with my cost of goods because they will vary from one stream to the next. Once you subtract your cost of goods sold from your income, what's left is called your gross profit. Gross profit is expressed in dollars. If you take a percentage of your gross profit as a percent of sale, that is called your gross margin. So when you hear people talk about what are your margins, that's what they're talking about. Shark Tank, they're always talking, hey, what are your margins? Well, this is your margin. All right, under that, after you get to your gross profit, then you're going to have your indirect or fixed expenses. So this is things that don't necessarily change directly with how many things you sell. For instance, rent, utilities, insurance, administrative salaries, those sort of things. They stay fairly constant from month to month. Subtract that from your gross profit, and that gets to your net profit. That's all an income statement shows, is those 1, 2, 3, 4, 5 basic areas and a little bit of detail in those so that you know what you're talking about, but not so much that it overwhelms things. So here's a sample of a profit and loss statement. So this particular company happens to sell and install artificial grass. So they have listed for their income, they want to know how much they sell in the grass. EnviroFill cells, that's an additive for making things pet friendly. Additional services, they also might install a paver patio or some rocks or something like that. That would be additional. And then when they install the grass, then they charge for that. And then they give some discounts to people. So under the cost of goods sold, to match up with that, you want how much does it cost to buy the turf, to match up with your turf sales, How much does it cost to buy the EnviroFill? How much does it cost for the additional services, and then contract labor on the installation? Once you subtract those out, you get to your gross profit. Oops, sorry. Below that is what we would call our fixed expenses. This company happens to divide them up by department. So they will look at all the installation expenses that are fixed, licenses, repairs and maintenance on equipment, buying small tools and supplies, sales expense, sales labor, trade show expense, promotion and advertising, and then the administrative expenses of rent, computer, telephone, all of those such things. So you get down to a total fixed expense, and then your net income is your bottom line. Got it? Got it. The next financial statement is the balance sheet. This one is one that people don't always understand and appreciate, but is an important part. A balance sheet covers one moment in time. So you'll see a balance sheet effective October 31st of 2020, of December 31st, whatever. It just is one point in time because so many things change day to day on it. It demonstrates your cumulative financial health. It shows three things. It shows your assets, it shows your liabilities, and your owner's equity. And here's how that breaks up. You've heard of the accounting equation. Well, that's the balance sheet. So assets equal liabilities plus owner's equity. And a balance sheet, yes, always has to balance. That's why you have this equal sign. So under assets, the things that are assets are current assets, which would be cash in the bank, cash other places, your accounts receivable, and your inventory. Then you'd have fixed assets, which are things that, so the current assets change and rotate as sales happen. So they come in, they go out fairly rapidly. Fixed assets are things that stay around, building, equipment, land, that sort of thing. So assets are everything a company owns. Liabilities are everything a company owes. So liabilities are broken up into two types: current liabilities, long-term liabilities. The general definition is a current liability is something that will be paid within a year. A long-term liability is something that will be paid over a year. So under current, you'll have accounts payable, notes payable, employment taxes payable, sales tax payable, your credit card debt, any of that. Long-term liabilities, anything that you owe over a year. You have an SBA loan, you have an auto loan, a loan to buy a building, that would all probably be a long-term liability. Then the other thing is the owner's equity. So this is the owner's capital, how much the owner put in to start the business. If there's any draws, they go against that. If you're a corporation and issue stock, you'll have common stock amounts, retained earnings, which are the accumulated profits of the business, and then net income, which are your current profits. An example of a balance sheet. You're going to have your assets, your liabilities and equity, and your total. So current assets would be your checking and savings accounts, accounts receivable. You'll notice on this one, this company puts their inventory under fixed assets. I'm going to say it probably should be up under current assets, but that's not a huge deal. Equipment and accumulated depreciation. Under liabilities, you have your current liabilities, accounts payable, credit cards, and then other payroll liabilities, sales tax payable, that sort of thing. Long-term liabilities, apparently this company got a loan from the owner that's going to be paid back in more than 1 year. And then under equity, your opening balance, your retained earnings, and your net income. Your chart of accounts, you've heard of this and probably don't fully understand it. But a chart of accounts is simply all the lines which are called accounts, which are found on either a P&L or a balance sheet. Your chart of accounts is going to have everything that has a line on one of those two financial statements and nothing else. That's it. So you'll see when you put the two together, you have a lot of lines on the income statement, a lot of different lines on the balance sheet. There is nothing in common between the two except when you get down here to your net income. And you'll notice that net income at the bottom of your profit and loss also comes into your balance sheet as part of your equity. Those two, or that one item, is the only link between those two sheets. Everything else is independent to the sheet. So when we talk about, I'm going to hit on double entry accounting just a quick moment. So a double entry accounting system means that you, for every transaction, there are two entries. So for instance, if this company sold $1,000 of turf sales, the second entry probably is going to go under accounts receivable because now someone owes the company $1,000. And when you say, well, how does your balance sheet balance when there's only $1,000? I don't have it here, but what's going to happen is on your profit and loss, if you sell 1,000 and you show no expenses, your total income, net income, is going to be 1,000. And like I said, that's your link. So now your net income is going to be 1,000 over on the balance sheet, and your balance sheet will balance. As you go along, lots of double entry will cross back and forth, but that is the only link between the two, is your net income. Did I mention that if you guys have questions, you can ask, put them in the chat, and Faith will interrupt me and ask those questions if I'm going too fast or there's something you don't understand. Okay, one other thing that goes along with financial statements is called a statement of cash flow. Now, a statement of cash flow has nothing new that an income statement and balance sheet don't have. It only rearranges those a little differently so that you can see where the cash is. And this is especially important if you're doing an accrual method of accounting, because you want to see, under accrual, you don't always have the cash when it's coming in or going out. So a statement of cash flow will cover a designated period of time. It demonstrates the ability of a company to pay bills. It contains both income statement and balance sheet items. And if you do it right, here's how it works. Don't you wish? Lots of cash flowing. So what are some of the things that affect cash flow? Well, obviously cash on hand, accounts receivable, because under accrual, that is something that you have invoiced, but you haven't actually collected money for yet. Accounts payable, because again, that's something you have accrued, but you haven't spent money on it yet. Inventory, you might buy inventory and have it sitting there, and you may have already paid for it, but you haven't charged it against anything because you haven't sold it. Credit cards, loan payments, interest of a loan payment is going to go on your profit and loss. The portion of your payment that goes to principal will go to reduce the amount that you owe on your balance sheet. Sales tax, payroll liabilities, depreciation, all affect cash flow, which brings to the point that you can show a profit and still run out of cash. It's pretty important that you keep track of what your cash flow is going to be. Okay, some other financial forms that you may hear about, see, or not understand. Sources and uses of funds. This is generally used, well, it should be used for a lot of new startup businesses. If you're going to invest in a new line of products, if you're going to be adding new services, pretty much anything that is going to require more money to be invested into the company. And depending upon where that money's coming from, we'll talk about that in just a second. So what this shows is where money needs to be spent, which is your uses. So in a startup, it might be, I need to do a build out of a building. I might need to buy some tools. I might need to buy some other equipment, a car, whatever other startup costs you may have. Or if you're having a new line of products, I need to buy some additional equipment. I may need to hire a salesperson. I might need to do whatever it is that's going to add money to that project. So all of those uses. So say you add them all up and you come up with $50,000 that you need to use. The next thing is, well, where's that money going to come from? The sources. If you're a startup, maybe you say, hey, I've saved my money. I got 10,000 of it. My dear Aunt Matilda is going to give me 20,000. So that's 30. Well, shoot, I still need 20,000. Okay, well, now I either need to go to a bank or find a potential investor. So now that's going to be 20,000 that I have to go look for under that. Potential investors and loan officers definitely want to see this form. They want to see what the money is going to be used for, and they want to know how much money you're asking for and where it's, and who else has got skin in the game. Break-even point. We're going to talk about this one in a little bit, but basically it shows the point at which sales equal costs and you begin to make a profit. It's a hugely flexible tool. And again, I'm going to show you some of the things you can do, and it's basically advisable for all internal planning. And then your startup costs for a new business. You need to show, what that initial investment's going to be. I see a lot of startup people come along and say, yeah, I think it's going to cost me $20,000 to start my business, but they don't really have a list of everything. It's just a number they pulled out of the air. You really need to make a list. Here's how much it's going to cost to make my build out. Here's how much inventory I'm going to have to buy to start this thing. Here's how much marketing I'm going to have to do to get it started. Anything and everything, you should make a list so that you know how much it's going to cost you. Then you go back to your sources and uses of funds, and the worst thing you can do is think it's going to cost you $20,000 and it costs you $30,000, and you've got a credit card with a $20,000 limit, and you've spent $20,000 and need another $10,000, and you don't know where that's coming from. So, a little planning. And then an assumption sheet. So assumption sheets are pretty much shows where you're getting the figures that you got. If you're going to a bank and you say, hey, I project that I'm going to have sales of $20,000 a month for the next 10 months, that's all well and good, but the bank's going to say, well, how do you figure that? Well, if you're a restaurant, then you can show him, well, here's how many tables I have. Here's how many people I expect to serve. Here's what my anticipated average check's going to be. Those are the assumptions you use that help you get to the end result. And it is a great adjunct to all the other forms. Okay, I'm going to blow through some accounting terms because I want everybody to know what they are. Some of them we've already touched on. I've listed them all here so that you can refer back to them at some future point if you want to go and read a dictionary. No, if you ever need to. Collateral. Collateral is assets pledged in return for a loan. Basically, you go buy a car, your car's collateral. You don't pay for your car, they repossess it. You go buy a house, you get a loan, your house is your collateral. You don't pay the loan, you don't live in your house for too long. Business collateral's a little different. Sometimes you have it, sometimes you don't. If you're buying a piece of equipment, your piece of equipment is collateral. If you don't have collateral, that's where SBA loans come in handy. Although most bankers are going to want to see some collateral. Debt and equity financing, two methods of getting money, but two different ways of doing it. So debt financing is if you borrow, usually from a bank, and you have a payback schedule of a monthly payback. It's at a certain interest rate, it's for a certain term, you're going to pay it back monthly. Equity financing, on the other hand, is where you find people to invest in your business and you don't pay them back immediately, but you give them partial ownership. Again, going back to the Shark Tank example, that's where you hear about, I'm looking for $100,000. I'll give you 30% ownership of my company. That's equity financing. Debt service is basically, for debt financing, it's the money you're going to pay on the loan. So it's the amount necessary to, basically it's your monthly payment. And banks look at this, they're going to look at your profit and determine whether you have enough to pay back that loan on a monthly basis. Of course, they're going to look for extra also. Disbursement, simply money paid out. Net worth, if you look back at our accounting balance sheet, net worth is when you have its assets equal liabilities minus equity. If you take that liabilities to the other side, have assets minus liabilities, that equals your equity or the net worth of the business. Working capital is basically the cash available to the company for ongoing operations. Sometimes if you project that you're going to lose money, you might ask for a working capital loan so that you can cover those losses. Accounts payable, simply money you owe to others. Receivables, money others owe to you. Assets, anything the company owns. Cash, immediately available. Checks, cash, bank deposits. Cost of goods, again, expenses directly associated with producing and making a specific product. Companies differ as to which expenses they attribute to cost of goods, but generally items such as source materials, direct labor, and freight are included. And I don't have a comic for this one, so you just get a little rest your eyes on a logo of all the different terms. And then it's back to more. Current assets, again, things that you can convert to cash relatively quickly. Current liabilities, anything you owe that's going to be paid with less than a year. Depreciation, this is a non-cash expenditure and pretty much is a tax deduction. So if you were to buy a building, you would probably think that that building would have a 20 or 30-year life to it. So you may spend a couple $100,000 to buy it, and then each year you would take depreciation on a portion of that amount. Again, the purchase of the building is up front, but the depreciation is after that. Equity, again, ownership of a company, fixed assets, fixed cost, things we've already talked about. Gross profit, again, revenue minus cost of goods sold. Gross profit is dollars. Gross margin is percent. Liabilities, anything you owe, long-term, more than a year. Net profit, this is commonly referred to as your bottom line. That's what's left over after you've deducted all of your costs from all of your income. Pro forma, if you hear someone saying, I need pro forma financials, pro forma simply means in the future. So all your financial statements that you get are things that have already happened. You get a profit and loss for the month of October, that's things that have happened. If you're going to a bank and wanting to get a loan or go to an investor, you're going to make some projections about future. That would be a pro forma. Retained earnings, the net amount of earnings that your net profit has accumulated over time. keeping records of your deposits. You think this is something that's fairly simple, but you think about it, and if you're not keeping in any accounting software and you have started a business, you're going to have deposits. Some of that's going to be income. Some of it might be money that you put in as an owner. Some of it might be money that came from a loan. If it all goes into the bank with no designation of it, and the IRS comes to audit you, they're going to say, oh, well, that's all income. And unless you have something to convince them otherwise, because again, the IRS does not make those decisions. The burden of proof is on you. And by the same token, make sure you track every expense. Number one, it improves your financial awareness. If you pay for certain bills out of your own pocket, out of your personal money, and you don't include them, then you're doing better than you think you're doing better than you really are. Plus, if you do it through the business, you get your good deductions. And again, you need to keep documentation and support. Did I see a question?
We do have one question, Mike, in the Q&A box.
So regarding retained earnings, with an LLC, is it true that those amounts are still taxed on the individual when they are earned, even if the money is not taken out of the business? Yes, but it's not the retained earnings that are taxed, because the retained earnings are from the previous year, not the current year. So your net income, which also is the one that flows to the balance sheet, is what's going to be taxed on your personal income. Net earnings should have already been, retained earnings should have already been taxed on a previous year. That get you? Okay, next section. If you can't measure it, you can't manage it. This is so true. So we're going to talk about, here's your fun extra credit formula. No comic needed, because this in and of itself is just so much fun. So again, break even refers to the amount of revenue necessary to cover your total fixed and variable expenses incurred by the company. The simple formula is break even equals fixed costs divided by gross margin. Remember, your gross margin again is the percent of your gross profit. So let's say a company has fixed costs of $5,000 and their gross margin is 40%, which means their cost of goods are 60%. To break even, that company has to sell $12,500 of goods or services in order to cover those fixed costs. Okay. However, now if you are able to get a 60% gross margin, which means your cost of goods is 40%, that same $5,000 of fixed cost, you only need to sell $8,333 to break even. I got to tell you, breaking even is not the ultimate goal for small businesses. You may want to do better than that. So here's another thing you can do with break even. Again, the formula is fixed cost divided by gross margin. So let's say you go, well, I don't want to break even. I want to make $5,000 in profit. Well, take your $5,000, add it to your fixed costs. Now you have $10,000 that you need to cover. And again, your gross margin at 40% means you need to sell $25,000 worth of goods or services in order to attain that $5,000 profit level. If you want to make $7,500 and your gross margin is 60%, now you only need to sell $20,833 to cover your fixed costs and to make the profit of $7,500. So here's where you're going to have to use your imagination with me as I walk through this. But let's say you are a company that says, okay, I want to make 5,000 in profit, but I think I might need to hire a salesperson, or I'm thinking of hiring some help in the office. Let's say you're hiring help in the office. Can I afford it, you say? So you're going to say, okay, it's going to cost me $2,000 a month to hire this person. So how much additional sales do I have to make in order to cover that $2,000? So I can simply take my 2,000 as my fixed cost. I can divide it by my gross margin. Let's say it's 40%, and I'm going to come up with $5,000. So if I can sell $5,000 more, then I can still maintain what I'm doing by adding a $2,000 a month person. So if I have to do that on this first example, if I want to make 5,000, I have 5,000 fixed cost, and I'm looking to add 2,000, I'm actually going to have to sell $30,000 worth of profit to cover all of that. Now you can make a decision. Is that possible? Yes or no? These are things that, once you have a number in hand, you can actually look at it and say, oh, nope, that sounds reasonable. Or you can say, I don't know, maybe I should wait on that. Maybe I should hire a part-time person. How much would that look like? Lots of numbers you can use. On the bottom example, I want to make $7,500 in profit, and I'm going to add a $2,000 person, but I'm making 60% gross profit. Now I only have to make an extra $3,333 in order to make that start to pay off. So now it's what, $24,000 and change in order to hire that additional person. Again, once you have a number, it makes the thought process a whole lot easier than trying to say, well, if I hire this person, can I do it? Now you know what it's going to take. Okay, other metrics to use in the same vein of you can't change it if you can't measure it, then think about things that are important to you and how you would put them into a formula. So revenue per productive hour. I want to know, I run a law office and I have attorneys, and I want to know how much revenue I get for everything I pay a particular attorney. How do you figure that? Well, total revenue divided by total hours. So I can take the total revenue that's generated by that attorney divided by the total hours he works. I'm going to have a number that I can now deal with. Maybe I compare attorneys. Who has the highest revenue per hour? What's the best? What's the worst? What decisions can I make from that? Next one, how many estimates or quotes does it take for me to actually get a sale? If I'm in construction or some other sales activity where I send people out to do quotes all the time, not all quotes end up in a sale. So how many does it take? Is one salesperson better than another? Is one type of job more lucrative than another? That sort of thing. So number of estimates divided by number of sales. Maybe you know this, maybe you don't, but the word per, anytime you can make a sentence with that in it, it means divided by. So up on the top, the revenue per hour means revenue divided by productive hours. Estimates per sales order, estimates divided by sales. Revenue per click, total revenue divided by total clicks. I see this a lot. How many clicks do you get? Oh, I'm getting 1,000 a day. Okay, that's one metric, but my thinking is clicks don't mean much if you don't get revenue out of them. So maybe you run different advertising things and you can say, well, okay, so if I get a bunch of clicks here but no revenue, which one's better? Or if I get a few clicks but a lot of revenue. So I can say, okay, how much revenue from each of these streams and how many clicks? So I can get revenue per click. Accounts receivable turnover. This is a measure of your accounts receivable by number of days. And so if accounts receivable are an issue and you're trying to get them down, this is a good measure to say, hey, my average is 60 days, but I really need to get it down to 35 days. You can track that. You can keep track of it. Customer acquisition cost. How much does it cost me to get a new customer? Well, how much do you spend on trying to get that customer? So probably all of your sales and marketing costs. You know, what I have a salesperson, I spend money on advertising, on trade shows, on marketing, other things. If I add up all of those costs for a month and divide them by how many clients I get that month, I probably have a pretty good idea of what it costs to get a new client. If I do that month after month, things even out and you can tell whether what you're doing is effective or not. The whole point of this is find out what you need, what you want to change, and then what you need to measure in order to change that so that you can follow it through on a daily basis or a weekly basis or a monthly basis. Okay, so here's your homework. Find your numbers. So what are the most meaningful numbers to you out of all the things we've gone through on the P&L, on the balance sheet, on the metrics to use? Which one rings true for you? What one do you really want to improve on? What one do you want to keep track of? Or few that do you want to? You can't do all of them, so start with something. And the good question is, what do you want to change? Because that's what you really should be working on, is my thought. The next thing, track them, communicate them, know them, and use them. I'll give you an example. I worked with a screen print company one time, and they wanted to figure out the efficiency of their screen printers. So they had 5 or 6 screen printers. So every day we said, okay, let's find out how many shirts or how many garments they screen print in their day. And so every day they would turn that sheet in and say, well, I did 800 or I did 400 or I did 1500, whatever. The point is, if you have employees or other people doing this, and you don't look at them and talk to them, the point is that as they turn those in, the supervisor should probably take a quick look and go, oh, you had a really good day today. Or, oh man, you kind of sucked today. What the heck happened? Give them a chance to explain themselves. If that happens all the time, you know you might have a problem. If you're looking at it going, you had a great day today, then not only does your employee understand that where they're standing, but you've let them know. So you can't collect data from people and not use it or not let them know. And then are you committed to that change? So go back to my example. If you've got one person who is really turning in lousy numbers every day, are you doing anything about it? Are you counseling them? Are you making sure that they have all the tools they need to do the job? Are they trained well? Or maybe you need to replace them. But, you know, if you don't use the numbers and you don't be committed to the change, there's really no need in bothering to collect them. I'm going to talk just quickly about software packages because people ask me this a lot. Do I get a software package? What should I get? Blah, blah, blah. Here's a list of 10, I don't know if they're the top, but 10 outstanding good software packages. And so what do you want to do when you buy a software package? What do you want to look at? What should you look at? So basically, number one, you want to look at the cost, right? Is it one time? Do you buy a desktop version and just do it one time, or is it a monthly charge, or is it something in between? Is it accessible from anywhere on any device? Maybe that's important, maybe it's not. Can you start small and then grow? Is it really double entry? If it's not double entry, you might as well use Excel. But I would certainly want you to use double entry. Is there job costing? If I'm in construction, I really want to have that because I want to know what my costs are for every job, what my revenue is for every job, and am I making money on each job? Credit card processing, maybe you need it, maybe you don't. Does it do estimates and quotes, accounts receivables and payables, inventory? All those things that you may or may not need, but at least figure out if you need them and if you'll need them in the future, right? So find what works best for you. My suggestion is pick 3 of those that we saw on that other page, and then look at what you personally want, online or desktop. What's the price? How many users? Sometimes, you're limited to a number of users and you have to pay for more. What special features does it have? And just because it has these great features doesn't mean you're going to use them. So see what you need, and will it grow with you? And with that, we are going to say thank you. And are there any questions?
There was one comment made in the chat box. I'm just reading through it. From Catherine. Awesome. So thanks so much for getting the information you needed out of per our question and information from Catherine, but everyone else, there is one Q&A question. From 2. The first one, what's your opinion of creating insurance agents accumulating commissions versus individual commissions tracking per person?
Oh, wait, I don't see that. Can you read it again?
Oh, no problem, Mike. It's in the Q&A box. And the question is, what's your opinion of creating insurance agents accumulating commissions versus individual commissions tracking per person?
I'm not sure I fully understand that. Is that person on? Can they talk? Do we have that ability?
Submitted under anonymous.
Oh, okay.
So anonymous, if you would like to clarify your question, you can always email it to us and we can forward that on to Mike to answer your question more specifically, just due to time. And then, and we'll get that to you. Another question, how to think about COGS for a service-only business with no outside contract labor. We've been operating as if we have no COGS.
You know what? A lot of service businesses don't have cost of goods. I see a lot of people trying to come up with something that they have, but if you don't have them, don't force it. Now, you may not, there's one thing that I'll advise when you're using the break-even analysis thing, you want to look at any variable cost. So a variable cost may not be in your cost of goods sold, but it might be truly variable if you're paying somebody a commission or something like that. But if you're a service and don't have a cost of goods sold, don't worry about it. You don't have to have it.
Great. So Mike, just due to time, we're going to go ahead and wrap up today, but I know we've kind of slowly getting a little bit more feedback, but if someone is wanting to sit down with someone like yourself, I know you talked about this a little bit at the beginning, but can you remind us how we can do that? Yes,
I can. Number 1, go to Maricopa-SBDC. Here, I'll type it in.
And so Mike's entering that information for all of you. If you would like to make an appointment, you are more than welcome to do that. As far as this session goes, we're going to go ahead and wrap up for today. Please join us on Thursday for another boot camp session. And so as soon as we get that link, which Mike just sent out to everyone in the chat.
Oh, actually, that went to all panelists, not everybody, huh?
Oh, that was everyone.
Maricopa-SBDC.com.
Perfect. We hope that you all take advantage of the resources like Mike said. I want to thank you, Mike, personally, because I am one of those people who are scared of numbers and run in every direction. So thank you so much for walking us through that. It was very informative and beneficial.
I hope it was meaningful.
Definitely. So thank you all again. We hope that you return with us Thursday at the regular time at 9 o'clock, and we'll see you then. Thank you all. Have a great day.
Bye.